Ladies and gentlemen, welcome back to the Crash Proof Retirement Show. We have an exclusive interview that we conducted with Professor Andrew Huszar just a few days ago, and now we have him back on our radio show simply because when we were conducting this interview, and this is the gentleman that was with the federal government for years, and he is the quarterback of quantitative easing. He was in charge of $1.2 trillion in a bond buying spree by the federal government. And just recently, Professor Huszar wrote an article. It goes back to November 11th of 2013, and it begins by saying, "I can only say, I'm sorry, America. I was responsible for executing the centerpiece program of the Fed's first plunge into buying bond-backed securities. 5 years ago this month, on Black Friday, the Fed launched an unprecedented shopping spree. The Fed said it wanted to help through a new program of massive bond buying purchases." This is where Professor Huszar's story begins, really. Having been at the federal government for 7 years until early 2008, he was working on Wall Street in the spring of 2009 when he got this unexpected phone call. And it was from the federal government asking Professor Huszar, would he come back to work on the Fed's trading floor? The job, managing what was at the heart of the quantitative easing bond buying spree, a wild attempt to buy $1.25 trillion in mortgage bonds in a 12-month period. Incredibly, the Fed was calling to ask if Professor Huszar wanted to quarterback the largest economic stimulus in the United States history. Professor Huszar, welcome to the show, and thank you so much for granting us your second interview in 1 week. That has never happened on the Crash Proof Retirement Show before. Tell us a little bit about why this has happened again twice in 2 weeks.
We were talking the other day about this bond buying program that the Fed has been doing for 5 years and got into this idea of when will it end? And funny enough, probably because we were talking about it, when we were speaking, the Fed announced that it was going to take its first step backwards in terms of reducing the amount of purchases it was making.
Did that surprise you?
The timing surprised me. So I anticipated that the Fed would be tapering their purchases at some point. Over the last few months, the pressure has been increasing on the Fed to pull back somewhat. So I actually thought it was going to come when the new Chairman Janet Yellen, was in the seat, and it actually happened when Chairman Ben Bernanke, in his last meeting as Fed Chairman. But the more I thought about it, the less it surprised me, because Ben Bernanke, I think it's a legacy move for him. This is his last meeting, and I think he didn't want to go out as the guy who kept on printing money and buying bonds. He wanted to at least make a somewhat of a step towards ending the program.
That makes sense.
But in my mind, and it's really interesting, because if you listen to a lot of the commentary, and you actually listen to what the Fed said on some level, it said it's going to end this bond buying program in 2014. And the other day I said to you that this was going to go on for much longer, and I still stay on that point.
And I think I'm going to agree with you there. What do you think of this concept? The debt ceiling being postponed for 2 years. Do you think, in your heart and soul, as I do, that the reason why they extended this debt ceiling for 2 years, it gives them another 2 years of bond purchasing power with this $85 billion?
I probably would come at it a little bit differently, because I do think the Fed bond buying, on some level, is connected with the fact that the rest of Washington hasn't really done serious structural reform in the last 5 years and really isn't doing much to deal with the issues in our country. So I actually think the fact that we keep on pushing off the debt ceiling, and it keeps on coming back every so often, and is on some level distracting the government from doing something hopefully more productive, is just forcing the Fed to step in and try to do more to help in an economy in which unemployment, even though the numbers are going down, the reality is a lot of the reason the numbers are going down is because people are dropping out of the workforce.
They're giving up on looking for jobs, right? Is that what you mean? They're just simply giving up on looking for jobs, so those people who stopped looking, who got discouraged, are not counted in unemployment. Is that what we're saying?
Exactly. And the Fed's job on some level, at least as it sees it increasingly, is to try to help lower unemployment. And so I don't agree, but it feels as if it's this tool of bond buying is somehow helping the average American. I think the data doesn't support that whatsoever. But it feels like this is the tool it has, and it's the only one who can actually do something. That's why it's going to keep on buying. And I also think, and it's really interesting because a lot of people thought the minute the Fed announced this idea of pulling back, the markets would react and sell off. And I think that's still going to happen if the Fed shows itself to be serious about pulling back. I actually think this announcement this week was sort of a minor blip because Bernanke is on his way out the door and because the Fed went so far in its communication to say, listen, we actually might start buying bonds again if the situation isn't improving, and we're going to do all these other things to help.
Is this another illusion? It sounds to me, listening to what you're saying, is that Bernanke wants to leave with a good legacy. Is this a token move to kind of say, okay, let's taper for $10 billion and maybe increase it? Do you think it could be increased again, or do you think this tapering of $10 billion makes a difference? And are you surprised that the markets went up?
I think it doesn't make a difference in terms of the way it's reduced. I mean, $10 billion is not a material difference, especially because the Fed keeps on indicating that it's all in to try to do whatever it can to help. So I think people took comfort that it wasn't a bigger cut. And I think that they took comfort from the fact that the Fed said, we're going to come back with all these other ideas for how we're going to help. And so is it possible they'll continue? Of course it's possible. But I just think, especially if the economy rebounds unexpectedly well, but I don't see that happening. And I also see that the Fed is increasingly political in the way it communicates. So every time it says one of these things and does one of these moves, it's really thinking about the PR aspects of what it's doing. But the underlying message is the Fed's all in still.
Professor Huszar, do you feel that the quantitative easing and the tapering thereof is going to make a difference at some time or another?
Oh, I think so. I think if they do actually start cutting the amount of because let's take a step back. What are they doing? They're really printing cash and pumping that cash into the banks, into the financial markets, and taking more and more securities onto their balance sheet. So what it's done over the last 5 years, and you see this in the stock market, it's led to a huge increase in the value of stocks. Stocks are up over 150% since the Fed started buying bonds. And so when the Fed actually says we're done, if it ever says we're done, that's going to be a very negative signal for
is that going to be like is that going to be like a balloon popping, or will it be like a balloon that's just letting air out of the other end that got untied? How's that going to play out in your mind?
It's the latter. They're hoping that it's this gradual balloon sort of slowly letting air out. But I anticipate that when it finally becomes clear that the Fed's serious about doing this, and that could actually take one or two more of these announcements, to be fair. But when it really becomes clear that to the markets that the Fed is taking away the punch bowl, so to speak, that we could see a huge sell-off. And that's why I think the Fed is going to be more resistant to pulling back, and is on some level it's going to be a really tough situation for the Fed because it doesn't want to cause any decline in stock market values, but at some point it may have to.
Out of all the people that the federal government had to choose from, they came to you, Professor Huszar, and asked you to be the architect of quantitative easing. Now, they had a good reason. What do you think it was?
Well, to be fair, I wasn't the actual architect. You had the people at the top making the policy, and it was backed by a lot of research and thought. But my job really was to be the quarterback in terms of figuring out, okay, we have $1.25 trillion that we need to use to buy mortgage bonds, and how are we going to do this?
So you didn't design the play, but the ball's in your hand to execute the play.
Exactly. Well, I think why me? I had a pretty unusual background in terms of having led some significant projects and efforts within the Fed, as well as having worked on Wall Street. So I married the market knowledge with the knowledge of the Fed and the risks and the rewards of doing stuff within the Fed. And also, let's be fair, this was in the middle of a financial crisis. The Fed needed bodies, and it needed people who kind of knew the institution as well as knew the market. So they ended up with me.
Would it be accurate to say, Professor Huszar, that you took this position to execute putting quantitative easing in place? Would it be fair to say that you have taken this thinking that this was just going to be a 12-month time frame in which they were going to execute it? Are you surprised that this has been continuing now for 5 years?
Oh, I think it's very accurate to say that. The Fed had already done a lot of emergency facilities before I came back. By some estimates, $1.5 trillion worth of emergency facilities. And I thought this was just the next one, and that it was perhaps the last one that the Fed would need to do to help stabilize the economy and allow for more serious reform of Wall Street and more serious reform of the U.S. economy to play out. Obviously, we were having a larger conversation in the country about how we needed to change and move forward and perhaps tweak the way we had been doing things. And so I've been very distressed, and one of the reasons I wrote the op-ed was that I feel as if all I helped do was double down on the past, and all I helped do in the end, now I realize, is help recreate the very economy that got us into the trouble in the first place, and it's an economy that isn't working for most every American.
In our previous interview, you and I both agreed that there are many in the federal government that are in the federal government because they believe in this country and they want to help the vast number of us. But I think we also agreed, and correct me if I'm wrong, that there are those that are higher up in the structure of the government that are maybe, perhaps, self-serving. Do you feel that the federal government kind of used you to accomplish what they're doing?
No, I don't. I believe in any company, whether it's public or private, you have people with different motivations. And I think that some people are more worried about their careers than others, and so have you. But I ultimately, even to this day, for as foolish as I think what we're doing is, I still believe that the people within the Fed generally are smart, well-intentioned people, and they're trying to do the right thing. I think they've just lost perspective.
Is it people that are above the federal government, say like senators and congressmen, pulling their strings?
The Fed is pretty good about being vigilant about influence from the rest of the U.S. government, because when you look traditionally at central banks, that's the fear people always talk about, that central banks get politicized and that they become too connected with the rest of the government. I actually think we have a different issue, which is we've allowed our government to get too connected to Wall Street. And a U.S. banking sector that was 20% of the economy in the mid-'80s is now at 40% of the economy today, and that's a huge industry. And also, within that Wall Street, 6 banks alone control 70% of the industry's assets. So these are huge corporations, and that's where free markets get a little bit off, and potentially those corporations may have just too much influence in the government.
Now, no one can predict the future, but certainly with the demographics and history combined with that data, would you please give our listeners what you feel? And even though we don't know what's going to happen in the future, can you break it down in simple terms and tell us what does it truly mean tapering down $10 billion on an $85 billion purchasing program to buy up these mortgage-backed securities? And what's your outlook for the next 5 years with this quantitative easing?
So there's a lot of people who say that the Fed tapering is going to hurt the underlying economy. I don't see that, because if you look at what the QE has done so far, it actually hasn't been that effective in terms of helping the economy. It hasn't stimulated Wall Street credit lending to the average American. It's helped non-financial corporations save a ton of money in financing costs, but those companies aren't turning around and investing into the economy. And there's many, many other ways in which I don't see how it's actually working. In fact, a lot of economists say that the benefits of the largest economic stimulus program in world history have been minuscule, maybe as little as 0.2 or 0.3% of economic growth over 5 years. So if I do believe that, which I do, I would tell you that the Fed pulling back is not going to have that much of an impact on the economy. Where it could have some impact, to be fair, is it could have some impact on the financial markets. And because the Fed has been pumping money into the financial markets, if it actually pulls away the punch bowl, we could see financial markets suffer. In fact, more quickly, because once the people realize the Fed is actually serious about doing it, it could hurt. And that could hurt investors. This is where I have a bit of a disconnect between it may hurt Wall Street, but I'm not sure how much it hurts the average American, who, by the way, 50% of Americans don't actually even own one stock. And 10% of Americans own 90% of the stocks in the U.S.
That sounds incredible.
It's incredible, right? So where do I see it going to the next 5 years? Well, I think we're in this long-term, extended
welfare for Wall Street,
where ultimately we may see financial markets continuing to do well because the Fed continues to buy, but we see the underlying performance of the economy and unemployment and the median income of the average American continue to go in the wrong direction. And so we have, unfortunately, this disconnect between Wall Street and Main Street actually get worse during the next 5 years.
Can you explain, because I know the everyday investor doesn't understand there's a difference between economy growth and market growth. And right now, according to experts, our economy is moving around 2.5% growth, but yet Wall Street has grown over 27%. Can you explain the difference between economy growth and why quantitative easing is not going into the economy and what the difference is between market growth? Isn't there a big difference there?
Well, I mean, the whole theory behind quantitative easing was this idea that Wall Street was basically on fire and they weren't extending credit anymore to the average American. And so the idea of the Fed buying bonds from Wall Street was hopefully to stabilize Wall Street and so as to be able to kick off lending again and get some cheaper credit or just more credit in the hands of those Americans that really needed it. And basically what we saw while I was there was that even though we were spending amazing amounts of money and pumping it into Wall Street, it really wasn't having any knock-on benefits for the average American. Banks weren't lending more. In fact, banks were continuing to decrease the amount of lending they were making to Americans, and whatever credit they were extending was typically going to those Americans who were the wealthiest ones, who didn't need as much of the help. And so, the Fed has progressively changed its philosophy of why it's doing this, and it's now the theory has been when seeing that Wall Street's not lending, the idea is, okay, let's try to, since we see that it's pumping up financial market assets, let's hope that those financial market assets will keep on going up, and those Americans that are benefiting from more wealth because of it will turn around and spend more, and that's going to trickle down to the rest of the economy. But ultimately, the point is the Fed doesn't have the tools to help, and really this goes back to the point that we need the rest of our government to step up and just make sensible reforms, not more stimulus, but sensible reforms in terms of infrastructure or education or tax reform or regulatory reform. We need to get this country moving again if we think of it as a business. We need to get the business recipe right.
Are you one day, being the quarterback of quantitative easing, going to write a book about this?
I don't know. We'll see if there's interest. I really appreciate being on the show here, and I really appreciate the engagement of your audience. But I will tell you, I am met more times than not by skepticism, really based upon the fact that most people out there look at stock market and say it's at an all-time high. They look at, some of the economic numbers, and on the surface, some of them look like they're getting better. But we've really lost sight of the average American here. And just because Morgan Stanley is making more money, I don't necessarily know if that's really helping most folks in America anymore. And so we'll see. I'm going to keep on talking, and I appreciate any support you and your audience can provide, and we'll see where things go.
You've written an 1,100-word article, and in the last 6 weeks, you've been a sought-after person to interview. And in the article, you say you're sorry to the United States taxpayer. Why?
Well, I think ultimately, I believe I helped, and the Fed helped squander the opportunity for meaningful structural reform in the U.S. I think the financial crisis was a big wake-up call. And I think 5 years after the financial crisis, we're in an economy that looks structurally eerily similar to where it was before the financial crisis in terms of Wall Street having gotten bigger and more concentrated, and in terms of the fundamental conditions for economic progress for the average American, whether it be, again, infrastructure, education, or just the overall competitiveness of the U.S. economy, we see that falling ever farther behind. So I'm sorry that I helped end up leading us down a path where we're basically doubling down on Wall Street and we're forgetting about Main Street.
Does it make sense to you, Professor Huszar, to pump up the economy and let the economy pump up Wall Street? It seems to me it's backwards. We're pumping up Wall Street, and very little it's doing for the economy. Does it make sense to do it the other way around?
Yeah, I think so. But I think on some level we need to get away from the idea that government, I believe in government, and I believe in smart government, and I believe government is a very integral part of the economy. But I think we get into trouble when we start looking for government over the long term to try to create economic growth. I think it's one thing to say there's a huge crisis and government steps in and provides emergency relief. That can happen. But when it's now 5 years after the financial crisis peaked, and we're still seeing incredible stimulus, we have evidence that shows that it's not really working the way that it was anticipated to work. So on some level, perhaps it's a moment to really take a step back, and it's hard because the stock market, again, is an all-time high, but a moment to step back and say, you know what, let's look at where the average American is today relative to where they were 5 years ago, and they've lost 40% more of their net wealth. And what are we doing to help them? I'm not sure we're doing enough.
Do you think the United States banks in this country has a best friend called federal government? Since the federal government subsidies, United States banks have seen their collective stock prices triple since March of 2009. I wonder if the everyday investor had tripled their same accounts in that way. Do you think we have a best friend relationship here between the United States banks and the federal government, since we don't see any type of regulation or any major bank officials being locked up for fleecing?
Yeah, I mean, I think if you look at the history of the United States, until the 80s, we had a huge mistrust of banks, or at least a healthy mistrust of banks. And we also had a healthy mistrust of monopolies or huge concentrations of corporate power in the hands of a few companies, because we worried about monopolies and anti-competitive behavior. And if you look at where Wall Street has gone, again, Wall Street is twice as big as it was in the mid-'80s today, and it's 15 times more concentrated in terms of the banking sector. So fewer banks controlling more assets. And, again, day to day, that's a hard thing to see happening. But if you look at the numbers over time and you look at what's happening, I think the federal government on some level has accepted the idea of our economy being reliant on consumption and on credit and on Wall Street. And I don't want to suggest that we don't need that in our economy. I'm not looking to shutter Wall Street, but I think we need to get back to perhaps a more balanced approach.
You're listening to the Crash Proof Retirement Show, and on our air and on our lines is Andrew Huszar. That would be Dr. Huszar. He is a senior fellow at Rutgers Business School. Professor Huszar, we certainly appreciate your time. And when you do come out and write your book, which I know will be a bestseller, would you please autograph and give us one?
I would love to. And again, thanks to you and your audience for having me on, and it's been a lot of fun.
And you'll come back and visit us again. The next quantitative easing, we're going to have you back, and we're going to want to know what you think about what's going to happen in the future. Thank you so much for joining us, sir.
Thank you.
The Crash Proof Retirement Show has been a production of RMI, Retirement Media, Inc., Truth for the American Retiree.